And it says live. You know how many times I've watched the replays on our halftime report and we're just sitting here like dopes for like 10 seconds, 15.
Yeah, Cam doesn't really let us know there. But it's a pleasure to be here, no doubt about it.
Welcome to the halftime report, presented by Tackle Trading.
Okay, welcome out to our YouTube show here, our halftime report presented by Tackle Trading. Coach Matt, Coach Tim here, and let's light it up, Matt. Let's get right into it. A lot going on this week. You know, last week was kind of a light week in the market. Now, if you're a trader and you know what you're doing, there's always something to do. You know, there's setups, there's trades, there's cash flow. But really, it was kind of a boring week. Let's call it like it is until the Amazon earnings later in the week. And then here we are, looking at the market, and now I'm seeing a lot of activity, Matt. You got the Fed meeting today and tomorrow. You got the Bank of Japan last night. You've got Apple earnings tonight. You've got setups all over the place. You've got stocks triggering. What's your take on all this stuff right now?
You know, 2 weeks ago in the market, we were dealing with all the geopolitical stuff with Trump going over there with the Eurozone meetings, and then the Russian meeting with Putin, and then it was a very big geopolitical type week. We had kind of muted response in the market, but it was a really interesting, exciting week from a geopolitical perspective. Last week in the market was a technical driven week. There wasn't a lot of economic data. It was earnings, but there wasn't a lot of economic data. This week, I mean, obviously we've seen it kind of start building on Friday. Yesterday continued. Just a tremendous amount of information out there right now, Tim, to the point where, you know, it's almost like it's information overload to a certain extent when you're dealing with all of this central bank policies, from the Europeans with the Bank of London to the Japanese last night. That was a very, you know, exciting. Well, I don't want to say interesting with what the Bank of Japan did last night, but it showed weakness. And I felt like it was tremendously weak to keep the, you know, depression level stimulus packages alive. They did some revisions where they kept the interest rate at the same level as at negative 0.1. But what they did change was they changed some of the long-term bond buying out of the Japanese government. And my question is, how much bonds can the Japanese central bank buy from the Japanese government? They're already maxed out, far more than the U.S. is.
Bring up the dollar-yen pair while we talk about this, because this was the headline overnight. And, you know, we talked a lot about the yen, and we kind of went through the Forex setup as well as, you know, the ETF setup. And there's several ways to play that, Matt. Those put options we were looking at yesterday, they're up nicely today, obviously. When you get a confirmation candlestick going up on the dollar-yen pair, it's going to drive the ETF lower. You know, I know that if you're brand new at currency, that can be confusing, but it's a cross pair, right? Explain that, because I think it's pretty. Go to FXY real quick. And we were looking at a put on FXY going down. When you look at the dollar-yen pair, is going up.
Yeah, this is just an inverted ETF that tracks the yen against the dollar. So this is going to be going down. When you're looking at you're looking basically at the exact same chart, Tim. You're looking with the.
Now, real quick, got to acknowledge something. Cameron, I know that you're out in up in the Northeast. I've got a weird video coming through YouTube, Matt.
I'm not even on.
I got to be in the moment right now. It's like coming through in the chat, guys. Are you seeing clear video, or is it on my system? I don't want to.
What video show?
Well, I've got YouTube over on this channel, just kind of watching and kind of watching the chat as well. And it's got like blue streaks through it, and it's dark and black. Screen looks funky. Try stop sharing and reshare.
Yeah.
And it might be on my side. Letty says clear. But for Adam, it was messed up. All yours are red. Paul, that means you got losing trades, by the way.
Yeah, I reshared it. I reshared and it should be working now.
Perfect. You know, I saw the funniest tweet on Twitter, Matt. You know that who's the guy who was real famous on PBS as a painter, did all the painting tutorials?
Yeah, I know who you're talking about. I can't remember his name.
It was like a meme where he's like, and I'm just going to now paint a weekly red candlestick right here, you know,
Well, that's what's kind of happening on this ETF right here. Now, let me get back to explain the difference here. You're really looking at the exact same chart here. You're looking at the exact same chart. You're looking at an inverted ETF. So when you're looking at the US dollar / Japanese yen pair, you're looking at the US dollar first in that pair. And so the US dollar Japanese yen pair here, you're looking at the dollar first. And so the chart's going to track the dollar. When you're looking at the other chart, Tim, when we're looking at buying put options on it, you weren't looking at the dollar first. You were looking at the Japanese yen first, and so that's going to be coming down versus the dollar Japanese yen pair going up. You know, when I put together the Forex report, Tim, for this week, I was looking at a couple different trades. One was on the dollar yen pair, the other one was on the euro pound pair, and then the other one was on a short dollar Canadian pair. And very rarely do I have a lot of confidence going in before a central bank monetary policy statement. But I just felt like the Japanese have been very consistent with how weak they've been from a monetary policy perspective. And that's exactly what they were. They were very, very weak from a monetary policy perspective. And because of that, you know, the Japanese yen is depreciating. But outside of the depreciation of the Japanese yen and the strength of the dollar right now, I just love this trend going into it. Nice little pullback last week coming into it, slowing momentum at a previous breakout level. It was a really, really solid technical pattern. Obviously, that is now appreciating, and so far, good trade so far.
Yeah, and quite frankly, it's the kind of trade that you could even build into the position. You know, scaling in is something that I see most traders do when they're losing money. And frankly, they would be a lot better if they learned to scale in when they're actually profiting on a trade. I don't know if you need to time that here right at this exact moment, probably not. But
no,
over time,
if you're not in the trade, wait a little bit. Wait for that initial, you know, price movement that we had coming out of the yen discussion last night. Wait for that to come down. And that's what you're kind of seeing at the top here, Tim. You're seeing that start to come back down on an intraday perspective. And so if you're looking to get into a trade from we'll put it like this. You know, we've had a few guests on the podcast that are what I would consider currency experts. And we've talked about the news-based trade before quite a bit in the podcast and coaches shows over there at Tackle Trading. The news-based trade is a very, very difficult trade to trade in the moment. And the reason it's a very difficult trade to trade in the moment is because you have so much randomness at the very beginning of the economic event. And so you have this massive volatility increase right when the announcement is made. And so that becomes very, very difficult because it's tough to place stop losses. And so a lot of the times it's better to wait till after the event kind of subsides into this level, like 30 minutes, an hour after the event to get into the trade. But a lot of people, when this is happening last night, especially on the East Coast, Tim, a lot of these people are sleeping or they're not paying attention to the marketplace. And so now you wake up and you're like, whoa, I watched this Forex report. Now it's already moving. I can't get in now. Well, no, drop that down into an intraday level. And typically I like 15-minute charts here, and wait for this from a technical perspective to settle down and set up from a technical perspective, then go long on it.
Well, and you know, it does lead us to the conversation about the dollar. Going back to your original question, how long can the Bank of Japan manipulate interest rates to a negative level, Matt? I'm betting they're willing to do it forever, quite frankly. These central bankers. And I really think that the new models in economics, they are filled with hubris, and they believe that these expanding balance sheets are not a problem. And maybe they're not. I don't
know. I don't know if that's what it is. I think it honestly could be, oh my God, we've went so far down this road that if we don't continue, we could just blow the entire thing up.
Sure.
I mean, you're talking about massive, massive debt from around the world. It's not just Japan. Look what's happening with the pigs in Italy. Look what's happening in the U.S. from a debt perspective. And I just honestly feel like the U.S. is the only one being responsible in any capacity from an interest rate perspective. And even though sometimes I feel like it's too late from a monetary policy perspective, it's almost like every other central bank is going down this road saying, oh my God, we don't know how to fix this. We don't know how to unwind the balance sheets. And that's what it really feels like with what Japan did last night. It's just a continuation. It's a waving of the white flag saying, we don't know what we're doing.
Well, and it's almost like that Alexander the Great story about burning the boats. These QE programs, they may not have a way back, is what it comes down to. More on that, obviously, as we talk about the dollar. And I actually think before we get into the equities, Matt, let's do UUP and the DXY because it ties into what our conversation just was. The US dollar is sitting in a zone that we would call a range-bound zone. Now, I believe you could get a lot of technicians in a room and argue about that chart. But the fact of the matter is it's flat, okay? Mm-hmm. Whether that's a reversal, whether it's going to be a continuation, it's going to be news driven, quite frankly. So we don't know which direction this is going. Is that right?
I have no clue. Anybody who says they have a clue, they're guessing. They're guessing. It's almost like I saw somebody on Facebook a couple weeks back go short before an earnings announcement. Mm-hmm. The market went down. And I'm thinking to myself, and they were bragging about it. And I'm thinking to myself, wow, any trader who actually knows what they're doing doesn't think highly of you right now because nobody takes a large position before an earnings unless you're gambling, right? We're in that type of situation. Traders are all probability based. 100% they're probability based. And right now it's a coin flip scenario. You got a ton of economic news that is coming out this week. You have the central bank announcing interest rates tomorrow, which will most likely stay flat. You got the Bank of London on Thursday announcing interest rates. That is one of the bigger movements. And I said this in the Forex report, and I talked about it yesterday in the halftime report. The two biggest economic situations this week, Tim, are not the FOMC and it's not the Bank of Japan. We pretty much know what they're going to do. I felt like the Bank of Japan was going to keep historically low interest rates, negative interest rate. I don't feel like the FOMC is going to do anything, but the Bank of London certainly could raise interest rates, which would put pressure on the dollar. And then you have the unemployment report on Friday. I think those two economic events are far more important this week than the FOMC.
Kick in UUP. I want to think about a trade idea here. Now that when you were talking, it made me think. By the way, I'm 90% probability based, I'd say. I'm at least 10% coffee, okay? So, and I literally do a pot every day. I'm a coffee guy.
You like coffee?
I do like my coffee. So, Matt, if we don't know, but we do expect volatility, why not an inverted fly or a straddle here on the UUP ETF?
You could definitely look at a potential straddle type situation on the UUP. Tim, anytime you start dealing with, I don't know which way it can go, but it can go very aggressively one way or the other. You certainly could look at a straddle or a strangle, long straddle, long strangle on the UUP. You couldn't do it on the dollar index in the futures because you can't trade it, and you can't do it in the currency market because you can only do a K trade type situation. But in the options market, when you expect movement based on an economic situation and you don't have that, what was the word yesterday? I got a feeling, right? You don't have a feeling one way or the other. Straddle certainly could work on something like that. Personally, I don't like it just because the UUP doesn't move that much. It takes a lot to get it to move even a little bit. So you'd have to do a tremendous amount of contracts, but it's certainly viable.
Now, just a thought here, with these ETFs, currencies are amazing. They're so important. I don't care if you're out there and you're not watching and trading currencies, then you have to add that to your repertoire, to your toolbox here. Because even if you don't trade the pairs, Matt, and I say this all the time, these ETFs are available, they're liquid. UUP has penny options, tons of open interest throughout the entire chain. Whatever the play may or may not be here, I'll probably price that through the day and we could revisit it tomorrow in front of the Fed. But definitely this Federal Reserve interest rate decision, we'll talk more about it tomorrow.
One way or the other, I don't expect this to move coming before the Fed. And even after the Fed really can move, but I'm still looking at that Bank of London on Thursday as a potential price mover, not the Fed.
Yeah. All right. Very good. Let's move on to the equity markets and start with the ES and, obviously the S&P 500. S&P's triggering today. It's bullish, showing strength. You got to like it. Now, it's only a 2 red candle pullback, Matt, so it's not got a lot of depth to it. And as an investor and a trader, you're looking at the pay range pullbacks from before, and you're probably in the back of your head thinking, yeah, but is this a trigger you play here when you only have a 2 candle pullback, trigger pivot off the 20-day moving average?
Yeah, of course. This is not a retracement. So I don't want to get too technical here. We say the word pullback quite a bit when it's something just pulls back into a support level. This is not a corrective retracement. A corrective retracement is something that drops a minimum of 3 candles, and it has to retrace a certain percentage, right? So it's got to retrace 21, 38, 50, 61% off the previous movement. So this is just one of your standard pullbacks. If you're comparing it to gaps, this would be a common gap versus, say, a breakaway gap, right? So these happen quite a bit where you just kind of drop a couple days back down into support, pulls back just a tiny bit, and then it creates a fairly decent, buying opportunity. And I am taking this as a potential buying opportunity, Tim. You came back down into a very important support level at 2,800. It dipped underneath that just briefly before it responded coming into the close last night. Big upward movement in price above the previous day's high on positive economic data. The consumer confidence report came in today and it beat the expectation. Consumers are very, very happy right now. They're spending their money. Very important coming into the holiday season. I would say it's amazing how the holiday season starts in like August now, but it's from an economic perspective. My whole point, it's good to have happy consumers going into fall and winter months. Consumers are happy. Economic reports are doing pretty decent right now. Market responded off support fairly aggressively up above the previous day's high. I would say this is a buying opportunity. Yes.
Yeah, and all the retails are going to be buying as well. And that seasonality impact, it's got me thinking about the retail sector. We'll get into that here in just a minute. Relatively through the entire market, Matt, and just kind of go through these ones pretty quick, then we'll talk about it. RTY up 1.33%, actually very, very strong today, coming back, but neutral. NQ is the tech sector, and obviously we're seeing a ton of strength in tech today. I like that setup possibly more than the ES. And then the YM you were talking about has some relative strength.
The only thing I'll say on the NQ versus the ES, and I do like this technical setup. This is more of a standard retracement type situation than the ES was doing. And I love this, that it retraced right into a very consistent trend line. As you can see, it's connected on our dots on our support levels 3 or 4 or 5 different times now, kind of setting up right there in between 2 rising moving averages. I really like this technical setup. The only caveat I would like to throw here, little monkey wrench, is you are dealing with a little bit of slowing momentum from a trend perspective. So you see a big increase in price movement followed by a smaller increase in price movement. That is slowing down. From a Fibonacci perspective, from an Elliott Wave perspective, you might say that that's coming to the end of the trend, but that's the only drawback from a tech perspective right now. It is trend slowing momentum, but otherwise it's a very, very good technical setup.
Well, and I guess one of the questions with NQ that you'd have to get into, and I already know pretty much my answer, but is it better to play the whole index, like an ETF, QQQ, something like that? Or would you rather go out and do your stock picking? Because I like Google better than, say, Netflix today, right? We'll look at those 2 companies, but when you're playing the whole index, you've got the balance of having diversity. But when you're individually picking, obviously you have the clarity of knowing which ones you like better. So it comes down to preference. Well, would you rather do the QQQ or these individual stocks?
I'd do them both. I'd have no qualms about doing them both. Do you want to take the reward versus risk of an individual component of an index, or do you want to take the diversification and take out the individual price movement of the individual stock? Individual stocks, Tim, like Google, can move a tremendous amount in a very short time. Mm-hmm. The market, and that's up or down. I mean, look at Facebook, look at Netflix, look at Twitter. I mean, those individual components can move massive percentage points in a very short time period versus, say, the entire index, whereas the index can't move that much. A big move in the market, Tim, is 1% right now. A big move in a stock could be upwards of 10%. So it's just a matter of, do you have the thirst for the risk? And for me, I certainly will trade the indexes, but I'll trade the individual components. There's nothing wrong with that.
Now, obviously you're going to do both. I do like Google today, and
let's take a look at Google real quick.
Yep.
Post earnings.
Yep.
Gap fill. Responding off support, slowing momentum candle. there's a lot to like here. A bullish Harami type candlestick pattern off of support level. There's a lot to like, but the question I have for you is, what's the best way to play this, given the risk out there from an economic and geopolitical situation this week?
Well, I don't have a trade on it yet. I'm not too concerned about the Federal Reserve announcement tomorrow. I remember when I started trading, I would avoid putting on new positions in front of that announcement, because it used to be that the Fed announcement would drive the market pretty crazy. It doesn't do that hardly ever.
It doesn't drive it nearly as much as people think, though.
Yeah.
I mean, most of the Fed's response, or most of the Fed's announcements, are very well known before they actually get announced. May shock us, right? So back when we were doing the quantitative easing, we were so fixated on Ben Bernanke's words or Janet Yellen's statements, and they would modify a statement just slightly, and the entire market would overanalyze that, and it would move the market on these types of little bit of a shocks. But over the last 3 years, Tim, we haven't really been shocked by any Fed announcements. I mean, remember one Fed announcement where the market was like, oh my goodness, what are we going to do here? I mean, no, especially under Jerome Powell this year. I mean, it's been very consistent.
No, and really, and I actually read an academic study, last night actually, about how the Fed's announcements have not been impacting prices as much as their forward guidance. So they'll come out randomly and talk about large asset purchases, and it might drive the price of the market. But actually, the announcements for forward guidance have been more impactful than these Wednesday meetings. They meet all the time. And I think it's been since 2014 or so when we were stopping the QE program and changing it as to when the Fed really had teeth that was driving stuff. Now, could that change as they raise interest rates? Maybe. And this Jerome Powell, I'm impressed. I got to tell you, I've been impressed with him since he took the helm.
So have I. And it's my natural instinct to rip on all things Fed. That is my natural instinct. But I do appreciate a Fed that is consistent with their wordings, with their language, with their projections. Even if you disagree with them from a fundamental perspective, they're not listening to you. At least the only thing you can say is, I respect the fact that they're willing to talk to us and tell us what they're going to do. But the one thing that you said, something that caught my eye there, Tim. You said, in 2014, when they basically said we're curtailing our quantitative easing, we're pulling back here. Since that time period, Tim, the market in 2015 was flat, 2016 up 12%, 2017 up 20%, 2018 up year to date. So the question I have for you, and the question I have for every single person watching the halftime report right now, is, given the market's response to 2015, 16, 17, and now 2018, did the Fed even need to step in and do what they did in 08 and 09 if the U.S. market has shown how resilient it can be?
It's one of the great questions, because frankly, maybe they did. I don't know. I don't think so. I would argue completely against the fact of what they did. They did not need to take the actions they did. But they have. And now that they have, you can't unscramble that egg. I don't know if you can. That's for a podcast. Honestly, I mean, we need to talk about that probably on our next podcast and really get Keith King and a panel of people in there and talk about the future of what this policy is going to do. Because, Matt, we're 10 years into the cycle, and we're now watching interest rate conversations about rising interest rates all over the globe. Say what the Bank of Japan did not do this week, but the Fed will say that they're going to raise in September, and in September they're going to raise, and they're changing. Right?
I'm going to hold my angst, because I do believe the U.S. is leading it from a positive perspective right now with interest rates. I do believe that normalizing the interest rate is a healthy thing around the world. I do not believe this debt-driven cycle it can end in a positive note from a market condition perspective, but those things are going to take years, if not decades, to play out. But as long as the Fed keeps maintaining, normalizing interest rates, I'm gonna give them a little sarcastic golf clap.
Well, I'm open to the theory behind all of it as well. Let's have a discussion on that on the podcast table. And going back to the original question, what's the best way to play Google? There's a couple of different things you could do. You could go deep out of the money and get a credit spread. At 22% implied volatility, I do think it's higher than the normal in the ranking, so it could come down. The overall implied volatility on the market's, going to stay in the low teens or mid-teens for So if I look,
let's look at those two. Okay.
yeah,
So let's price both of them out. So you can, so here on Google, okay, we like the technical condition, but we don't want to be aggressive because number one, it hasn't confirmed yet. Number one.
yeah,
Number two, we have, we're still very cautious after the 2-day teeth kicking that the market had the last 2
sure.
days. People are still very cautious, so they don't want to just jump into the pool. They want to dip their toe to make sure it's, safe water, for example. So you want to be conservative in this, and you have a debate internally in your head. Do you go delta or do you go theta? If you go delta, that's going to be a little bit more aggressive than theta, but you're also going to have a potential to make more money. So the two trades that you're really kind of looking at here on Google is you're looking at a bull put spread from a credit perspective, or you're looking at a bull call spread from a delta perspective. So let's price both of them out using our rules. Okay. So
Well,
Tim,
I'll tell you, here's a debate within the rules though, because I was looking at this in the morning. The 31 and 38-day options are weeklies, which I generally will trade. Okay, but a lot of beginners out there would look at a rule book and say, "Well, it tells me not to trade that." And then also, Matt, if they look at the open interest, it's going to not have a lot of a number there. But you got to remember out there, they just created those weeklies within the last 10 days. The markets are going to trade. Google's one of the top stocks in the entire market. Worrying about liquidity on an option, I understand it, but at some point you can go too far.
If the bid-ask spread are tight, you're fine.
Yeah.
I have a student I'm working with right now. She actually might be watching the halftime report, and I told her, I said, listen, where you're at in your trading career, I'm not going to allow you to trade weeklies. I'm not comfortable with you trading weeklies right now. And that's just because she's new to the market, right?
Well, that's you as a mentor trying to shelter her from making mistakes.
Well,
right?
I'm always thinking risk, right? I'm always thinking risk. So, but as a trader who's been trading for many, many years, trading weeklies is not a bad thing. Weeklies are a very good thing, but you have to realize they're less liquid than the monthly options. The monthly options are the white ones. The weekly ones are the yellow ones here. Mm-hmm. But when you're dealing with a very, very liquid stock like Google, there's no problem trading a weekly option as long as the bid-ask spreads are tight.
Yeah. So open that 31-day option right there.
Okay, so very quickly, for those of you watching the halftime report, when we are pricing out a credit spread, we typically start by looking at the number closest to 30 days. Mm-hmm. And the reason we want to look at the number closest to 30 days is because of theta. Theta starts to rapidly increase the declining rate in that last 30 days. So we want to capture that declining rate of theta. So that's why we start with the closest next to 30 days. Now, the next thing, so whenever you're dealing with option strategies, ladies and gentlemen, you're always dealing with time and price. That's what you're always dealing with, time and price. The first thing you have to select is the time. We selected 30 days. The next thing you have to select is the price. Now, the price, we always start with a 0.20 delta from a price perspective. And so a 0.20 delta is right there. You certainly could be a little bit more conservative, Tim. There's nothing wrong with that. I'm saying the highest you can do is a 0.20 delta. But before you ever sell that 1170 contract, just make sure you come over here at the chart and make sure you're selling at a level that you feel comfortable with. So Tim, the 70 delta the 1170 strike price with the 0.20 delta puts your selling right in the middle of two.
Yeah, I would go lower delta.
I would go lower too. Yeah. That's why you start with the rules and then you modify it based on your own personal take. It's like, Tim, you're cooking a recipe and it says call for a pinch of salt. Right? Then you have to determine that. We're just trying to follow the recipe and then modify it. So both of us don't feel comfortable selling between two rising moving averages. So we're going to go down a little bit underneath those moving averages, and we'll just say somewhere around 1160. So we're going to go to the 1155 contract right here, Tim. So if I go to right click, sell, vertical. Now, Tim, we have a $2.50 spread here. What would you do? Google's an $1,100 company, right?
I do a 10-point spread.
Let's do a 10-point spread. It's above 1,000 points. Let's do a 10-point spread.
Well, and here's a thought on that, Matt, because if you're running spreadsheet numbers, your ROI percentage will be higher on a smaller spread. Mm-hmm. But because if you don't open the strike price window, the mathematics are too tight, and also it's harder for you to actually materialize that return. Okay, so you need that.
Your thetas are almost identical.
All identical trades. So on a stock this size, I'd rather open the trade up. And I'll just show you a real quick comparison. On a 10-point spread here, you get a $1.15 credit. That's 11.5%. But if you go to the 1150, you're getting a 60% credit on $5. So that is more like 12%. So you got a little bit more percentage. And if that was the only factor, then maybe somebody could make a case, but it's not.
I like $5 spreads underneath $1,000, $10 spreads above $1,000.
Yeah.
$2.50 spreads are fine under $100, under $50, $1 spreads are fine. I mean, it just depends on the price you're looking at. But a general rule of thumb, if you're above 1,000 points or $1,000 on the price, look at 10-point spreads. And for those of you who are new to the market, 10-point spreads just simply means the difference between what you're selling and you're buying. So we're selling the 1155 or buying the 1145. We're getting a $1.15 credit off margin of 885. You're right between 11-12% projected ROI. On a delta of 16, your projected probability is 84% with a projected 12% ROI. Okay, over the next 30 days, and that is a good way. I mean, you're selling this one here at 1155. So you're basically in this range. Let me get a box and I'll draw the range so people can see it. So you're basically in this range right here between 1155 and 1145. As long as the market stays above this level over the next 30 days, T, with the projection technically that you think it's going to go up from here, as long as the market stays on that over the next 30 days, you're going to be profitable 12% in a 30-day number. And I think we can all agree that that is a good trade. In fact, let's throw it out to the listeners out there. Everybody listening, would you agree, yes or no, that having 84% probability of cash flowing 12% is a good way to play Google right now? Yes. How many of you guys agree with that? Now, there's always a little bit of a lag when we go live, but while they answer that, T, okay, on the flip side, if you have a very strong bias, well, maybe not a very strong bias, but if you have a bias that Google is going to go up, and you want to have an open-ended risk graph. And what that means is that you have the ability to make more money. So for example, when we're doing the theta trade on Google here, and we just go down to that, and I just want to quickly show them the risk graph here. So analyze sell, vertical, then let's modify that just a little bit. Okay, so 1155 by 1145. All right, so basically here's your risk graph. You have a closed-ended risk graph is basically what you have, right? So basically closed-ended risk graph is you can't make more than you sold. So we can only make that $1.15. We have 84% probability of making that $1.15. On an open-ended risk graph, it allows you to make more money. So if you want to, if your projection is you think it's going to go up and you want to hit a proverbial home run there, then obviously you're not going to do a selling type technique. At this point, you would do what's called a bull call spread. Now, Tim, on a bull call spread,
you can, yeah. And I will just mention this: having strategies to work through and compare is the cornerstone of trading, Matt, because we don't always go to the same technique. Watching you go through the bull put, then compare the bull call, this is what traders do on a daily basis when they're making decisions about how to play these setups. It's what I love about options, quite frankly.
Well, yeah, and all I've done here, guys, is I just traded a bull call here. I went and I bought the 50 delta call option. It's at 1245. I then came out of the money and sold the 25 delta option, which is the 1330 here. That creates a debit spread is what it creates. And so basically what you're doing, instead of just going to buy this at the money option for $4,900, you go and you buy that option, you sell it deeper out of the money option. So basically you're buying a good option and you're selling a bad option. The net debit is 3160. Now here, Tim, from a technical perspective, where's your target here? You're targeting 1300 previous levels of resistance. Where's your target here?
I think 1300 is a pretty clear target for me. I would make that a first target. This would be one where, and I learned this from you a long time ago. It's good to have two targets, right? You want to have one for a quick swing trade setup, knock some profit down, and then probably another one where you're going for a little bit bigger gain. By the way, trading all of these strategies look fine. But I think the best way that I would probably trade it. And I'm getting.
That target, you can say, okay, let me just drop us at 1300, and then I have it start at 1350. But now you have an open-ended risk graph, right?
Matt, hold on a sec. Hold on. Time out. Okay. Your audio just.
Timeout's fine.
No, the audio just went crazy.
Okay.
So, yeah, we're getting some audio issues. Yeah, some buzzy stuff here. So let's back up on that for a minute.
Yeah, it's. Hold on. Let me stop sharing very quickly.
Let's try that one. Let's do that. So, by the way, you're looking sharp today. Those microphones literally drive us crazy, right?
Say good.
Trying to figure out how to use technology and microphones at times can drive me up the wall. It's the nature of the modern problem. By the way, if you want to, I'm going to show you
Blame Comcast.
I will blame them. I'm not worried about it. I'm not worried about it. We're back here, guys. And obviously, if you hear something like that, let us know. But Matt, out of both of these, this is what I would generally do for any beginner or intermediate advanced trader. And I think the bull put would be where I would like it if I want a probability trade. It would depend on the composition of my account. A bull call would be fantastic. But what if I'm going for a home run? Neither one of these are home run potential.
Keep going, T.
Yeah, no, and I say, what if I'm going for a home run? And there's several different ways that you could build a position that could open up the risk graph for a home run. Now, whenever you're going for a high potential profit trade, you're going to carry negative theta. There's no doubt about it. But what you could do, Matt, is you could buy more options out of the money and sell some kind of ratioed spread. That would be more of a conversation for an advanced show like the Cash Flow Club or something we do with our community. But I like the bull put. I like the bull call. I mostly just like the setup. And when it comes down to it, when you're looking at a good technical setup, you can find a way that makes logical sense to go ahead and play that.
Well, it just goes back to how aggressive you want to personally be. If you want to be aggressive because you feel like price is going to appreciate fairly aggressively, then you can do the bull call spread here. That's a good trade. If you want to be a little more conservative because or you want to be a little more cost efficient because it's going to be cheaper to put on the bull put spread than it will be on the bull call side. If you want to be a little bit more cost effective and if you want to have higher probability, with a cash flow strategy, that the more conservative way is the bull put. Either way you go about it, if your projection is up, bull trades are good.
I agree. Moving on from Google, take a look at Netflix, which is not set up yet. By the way, Dang had a great question in the chat. Would you play it today or tomorrow? Tomorrow for confirmation, if you're trading it directionally, price the numbers today. You could look for intraday confirmation by the end of the day, Dang, but I don't think it's set up yet for Google.
I would say this on that. That's a great question, Dang. If you're doing the bull put, you could do that today and you'd be perfectly fine. Mm-hmm. Okay? It's bullish uptrend. You're sitting at support. You don't need to wait for technical confirmation like you do when you're going directionally. If you're doing the bull call spread, I would wait for a close or for Google to move above today's high.
Absolutely. Netflix here, kick it back to a weekly chart because really the whole discussion for me starts with the weekly chart. And I really like this bull setup potentially on confirmation and a trigger from a weekly perspective, Matt. Don't like the daily chart yet. Okay. I just call it like it is. We played that thing bearish coming down. And by the way, what a call.
Yeah. I mean, it was, yeah. Sometimes you're lucky. Sometimes you're good. I'll take both of them. I think both of us felt like it was just completely crazy to see this fill that gap in one day. Both of us played it to the downside here. But now, I mean, if you are short coming into that, I think it's time to lock in profit on that bad boy.
I agree with that. First of all, I locked in on Friday afternoon before the bell. And so I even missed out on the big move down on Monday. Could have made more money, but I made a profit and it had done what I wanted it to do.
Are you looking at this from a buying perspective? Because if you're dropping this down into a weekly chart, Tim, you're not looking at this from a swing trade perspective.
No,
there's no setup on that daily chart that says swing trade to the buy side. I could understand an argument though for a buy side mechanic if we start to see some price movement above 350 from an investor perspective.
Yes, I'm thinking about more long term. Netflix is a tackle 25 stock. It's a wonderful company. It's got great fundamentals. The analyst, we could analyze that here with Netflix. It's always going to be a buy. I love the company. It's always been one I liked. The play on the downside was just a technical swing trade setup,
Oh, and that's just a gap fill. This is nuts, crazy setup. Netflix is it's overvalued from a PE perspective, but Netflix is still a darling of the market.
Yeah, I agree. So it's not one you play today.
Think about it. Okay, let's go Netflix, Facebook here. All right, both part of the FANG stocks, right? Facebook and Netflix.
Right.
Netflix showing some weakness coming out of earnings. Facebook itself has shown weakness coming out of earnings. Facebook getting absolutely crushed last week. Facebook's never seen a candle like this from a weekly perspective. You drop this down into a daily chart underneath its 200-day moving average, trying to find its footing here at 170. But that underneath that 170, underneath that 200-day moving average is very concerning. It's got better valuations from a PE perspective. The PE is at 29 compared to Netflix at 150. But in terms of Netflix, you're still above the 200-day moving average. You're trying to find support here at 330, bouncing off this previous level of resistance over here. On the weekly chart, I'm certainly seeing Netflix as a stronger option than Facebook, right? Both of them have risk here, but let's throw it out to the team. If you're looking at this from an investor perspective and you think that these are both Facebook and Netflix was an overshoot of what their true earnings really were, and you had to pick one, which one would you pick? Facebook or Netflix here? You got to pick one, Tim. Which one?
I'm going with Netflix myself.
I probably am too. First of all, Facebook is not close to being out of the woodwork from a political perspective. Those regulations are coming. Okay. I don't care who controls Congress. Facebook is hated by both parties right now. And so those regulations are coming, and that's going to impact them. If Facebook also starts purging these fake accounts, these bot accounts, that's going to have an impact to the same that Twitter had an impact. That's one of the reasons Twitter got absolutely annihilated on its earnings, because of their massive 80 million purge accounts. And again, I celebrate, good Twitter, good job purging robotic accounts for fake economic reasons. I'm glad they're doing it. Twitter sitting down here at its 200-day moving average, trying to find some support right here. That's another one I'm looking at from an investor perspective. So if I'm looking at Twitter, Netflix, or Facebook, and all of them have risk because all of them are coming down tremendously, I would say Netflix 1, Twitter 2, Facebook 3.
I agree. And by the way, remember the analysis on Twitter. That's why we played it as a slingshot with the 2-in-1 open-ended risk graph on both sides, right? And definitely an interesting play there. I love the tech sector. Obviously, look at all these setups, Matt. Facebook, Netflix, Amazon, Google, everything is setting up. There's a lot of opportunity happening.
When things come down, there's more opportunity when things come down than when they go up.
Yeah. Make sure you get confirmation and plan your trade. Don't chase everything, obviously. There's a few sectors I want to look at and a few different companies also from our bull and bear watch list I want to update us on. XLRE, Matt, what a wonderful candle today. Here's patience paid off.
Oh, finally. I'll tell you though.
Did you stay with this one?
I'm still in it. I'm still in it. Yep. I prepped the trade a few weeks ago. My stop loss was at 32.05. I said that on the halftime short a week and a half ago. It tested it a couple times, even as early as yesterday, seeing big downward movement, came to the bottom here. That's why putting a stop loss under support is so important. And also staying with the trade. One of the mistakes people make is they're too quick to pull profit. Stay true to the trade. Trade's obviously rewarding us today. trying to track up to its first target of 33.25. To me, this is a solid trade. It's working out, and I'm going to let it run.
Well, going into the Fed meeting, obviously interest rates are going to affect real estate pretty directly, but I don't really expect a lot of volatility here.
If this was September, I would get out.
Yeah, me too. I'm about 20 cents away from my target here, Matt, which isn't a big deal. Do you ever pull a trade down that early if you're getting close and you got an event? I'm not out yet. I know what my answer is, but
okay. If the Fed's meeting tomorrow in September and I expect interest rate increases, XLRE most likely would not be appreciating like this the day before it. So that's number one. Number two is, yes, it's appropriate to pull contracts or to pull shares at your price target. That's fine. But I think it's a mistake on a big update like it is today, especially because it's breaking some pretty significant intraday levels. It's up above those levels. I certainly expect 33.25 to get hit, and then also and then perhaps even broken. So no, I'm staying in the trade.
Yeah, I'm in as well. Just, the thing about trading is you always got to ask those questions and kind of work through it within your system. During a trading day, you shouldn't come off your plan, though, right?
No, of course not. But that's also the purpose of the halftime report, is to have us have these conversations so that people can start to see not only the mechanics and the systems and the strategies and the daily routine, but they can see the mindset of two traders talking about trading.
Well, and think about this one right here. A beginner, and I remember going through this myself, and you even have these emotions as a veteran. You just have been broken down to where you don't care, right? You've done it too many times.
I don't know how to take that. Hold on.
Oh, you can get to that right in a minute.
Broken down,
all of us,
level that I don't care. That is a very nihilistic response from you, my friend.
It should be. When you've taken 10,000 trades, one trade is not going to make a difference, right?
Keith King would have said, "Hey, you need to trade more."
Well, what I'm saying, nobody can keep up with the Godfather, dude. There's no way. I'm not going to set my bar at Keith King. I promise.
I think he's at 27 million, by the way.
27 million trades.
Mm-hmm.
Sweet. Dude.
That's astonishing.
That's but anyway,
that just makes him a veteran.
So here on a big green candle, it's easy to crow about it and say, man, look at the great trade. But the emotions, if you're a beginner, Matt, and you took a technical analysis course, and this is your very first trade, and you go through your checklist and you find the trade, you prep it, you get confirmation, you do all of the analytical work, green candle starting to work, and then boom, red candle. I've done this enough with beginners, so that can throw you out.
It can, but I've spent maybe 5 minutes looking at this trade from the time I put it on.
Yeah.
I had my stop loss, I had my target set. I take a peek at it every day, and then I move on.
And I think there's great wisdom in that, guys. Kind of the whole point of the discussion. Let's move on to another stock that I love, XLY. I like the retail sector right now, Matt. At some point, we don't have to do this today. We can maybe have this examination later. I was digging into the composition of XLY, and it's heavily weighted to the Amazon side. Just 20% of the stock, this ETF is just
like 24%. It's crazy. Amazon. And the next highest is like 6% or something like that. It's like Home Depot.
It's something that you have to think about if you're out there and you're an investor. You got to know what the composition is. If you bought this thinking I'm in an ETF, well, yes, you are. If you think you have complete balance, you don't necessarily. You're investing 25% of whatever money you put in XLY into AMZN because of the holdings and the composition of that. And there is another play here, though. I like XRT at some point because of the seasonality with the real estate or retail sector coming into August, September.
Got an ugly chart.
They tend to do better, though, in the fall. XLY is a better chart because Amazon's a better stock. But it would get down to the debate, why not just play Amazon? I mean, I don't know. What do you think? It just had me scratching my head this morning.
I honestly, they're very, very similar. This one's weighted a little more evenly. Amazon in the XLY is not weighted evenly. It's 24% of the basket of XLY. Amazon's a great stock. I don't mind having a lot of Amazon.
Yeah, I do like that XLY setup from a sector perspective, and it's looking nice. It's very liquid, 5 million shares a day.
But that's the only concern.
XLF is one of the bearish ones. You're bullish on industrials, is that right?
Well, I just want to pull up the industrial chart because it's starting to show some weakness. I've been very concerned about it. but it's starting to, it was showing weakness at resistance. Now it is showing strength, getting above its previous levels of resistance. I think this is a very bullish move on industrial, Jess.
Yeah, I agree. You know, and there's no bigger industrial than Boeing, and it's on the Tackle 25. I was very neutral on their earnings. It's showing us some strength here with the breakout. But one sector I want you to peek at is the XLF, Matt, the financials. When I went to the heat map this morning, there was only one area that was completely red, and that was XLF. You know, hitting resistance, red candle, but still in a short-term upward move. Banks into Federal Reserve event, is that kind of the reason? What do you think?
No, it's had resistance. It's had, fairly decent price appreciation. Most of the banking stocks are setting at key levels of resistance. If you look at kind of Goldman Sachs here, underneath its 200-day moving average, but it's shown really good price appreciation. It's just kind of slowing down. Morgan Stanley here kind of doing the same thing. I went short on Morgan Stanley right back into here, so it's about time it's actually showing me some profit. But it's just at a key level of a trend line coming back down. You look at Bank of America, Tackle 25 stock, one of the better banks out there, actually, to be perfectly honest, from a price perspective. It's just that all these bank stocks have ran tremendously, Tim, over the last 2-3 weeks, and they're just slowing down here. That's all that's happening. I don't think there's any money rotation going on. I just think the banks are slowing down a little bit.
Yeah, financials. If you're looking for a few Wall Street banks to sell short, though, I mean, now could be a time for it. You'd have to go through and find a
I never feel better than when I'm short banking stocks. That's when I feel like my best.
I know. A couple of different short setups I like. BBT is setting up nicely, Matt. Fair trigger after earnings, kind of the opposite of the Google mindset. It gapped down on earnings, backfilled a little bit. It's below all those moving averages right there. This was not my find. This was on the stock report from Tackle Trading over the weekend.
Another good pick.
Yeah, I like that.
It's interesting when you put those reports together, because when you're putting those reports together, a lot of things haven't set up yet. You're looking at trend and pattern. You're not necessarily looking at triggers, because when you're putting that report together on a Friday afternoon after the market closes, or Saturday morning when nothing's really happening, it's like you take it from here. That's what that candle was doing right there. And the setup is, if it confirms, comes back down, you're looking at a potential shorting opportunity. This was a great find. I love the setup today. Small candle hitting the 200-day moving average, big red candle on the downside. This is called a bearish engulfing candlestick pattern. When you have a massive bearish candle with the preceding candle being a small candle completely engulfed by the other one, that is a very good bearish trigger right now.
I agree with that. And then also one other pick I found from the report that I think is triggering today is that LNG stock. Or no, excuse me. Is it LNG?
It's LNG. It's an energy stock. It's LNG. This one is a different technical setup than the BBT trade. The BBT trade, bearish downtrend already confirmed, retracing into a 200-day moving average, showing tremendous weakness. This one is a reversal kiss of death type formation on the short-term perspective, also a very powerful reversal, continuation type pattern off a reversal. Here's your head and shoulders over here. Head, shoulders, knees and toes. Here is your retracement. Look for that to break down. Now, Tim, if I'm looking at making this trade today, I'm personally looking underneath this intraday support level. That intraday support level is right at 63.55. Any trigger under 63.55, I'm looking at that from a shorting perspective.
Yeah, I agree. And then one that we have to look at is Tesla and Apple. And I think that those are the last two we kind of talked about here today.
What about CMG? CMG is feeding people E. coli burritos again.
Listen, I mean, I had it on our prep sheet because I wanted to hear you rant about Chipotle again.
I'm not going to rant. I'm not going to rant. I will just say, Tim, the last time Chipotle was overvalued the way it is today, and they came out with negative news from a health perspective, it went from 700 to 400 in 2 months. I just want everybody to understand that.
Well, pull that back and look at it, because I think that was kind of the point. I read today that in Ohio they had to close a store down, and there was something Same kind of headline. Chipotle slumps 9% after Ohio outlet linked to food poisoning complaints. That was 2 hours ago. They closed an Ohio restaurant. They're shuttering in Ohio. So when they've had problems like this in the past, they're a high multiple stock. Their valuations are out of whack. This is an example of when you have a very high multiple, when you have problems with your company, it can get crushed. And that stock went from 700 to 400 in like 2 months. You know?
It was coupled, and it's eerily right now because it was coupled with a bad earnings report. And then literally like a week later, it came out at some story, and I can't remember where it was, but it was like 2 or 3 different stores. It was back in the E. coli scare of a few years ago. And, you know, those two things coupled together, Chipotle went down tremendously, which was the initial starting of my hatred of all things CMG. But you're kind of seeing a very similar situation here. Tim, I'm looking at a potential, you know, I wouldn't do anything in the range CMG's in right now. But if I see a break of 420, you call this on our prep for the halftime report today. If I see a break of 420, that could easily get down to 390 in a heartbeat.
Yeah, 380, 390 in like a blink of an eye. And then your target would be around that 340, 350 mark. It's a watch list stock, Matt. See, sometimes
I'm going to watch it every day.
Many times when you're going through your routine, guys, you find stuff to trade for sure, but really you start to find stuff to kind of cultivate. You know, I'm going to plant a seed in my head on CMG here. And if it does set up, we will have a bear play map, but not till a trigger.
Yep.
You know, 2 stocks we have to look at, Apple, which, by the way, we will do a full analysis of tonight in the Coaches Show. We're going to spend most of the hour on Apple's earnings, kind of deep dive into it. What do you expect here, Matt? The market's hoping that Apple comes in and saves the day. You know, what do you expect?
Well, especially after Facebook, Netflix, some of the other, you know, earnings announcements we've had recently, the market's looking for you know, an absolute home run here. I can't remember exactly what the analyst expectation is, but I believe it's somewhere around 215 from an earnings per share perspective. Net revenues were supposed to exceed 50 billion. I can't remember exactly what the number was. If you can hurry and find that number, Tim. But revenues are supposed to be around mid $50 billion. I mean, that's not exactly a blowout number for Apple, mind you, but we're looking for something to exceed the revenue projections. We're looking for something to overcome the earnings per share. But I think even more than that is a lot of these tech companies have discussed in their earnings, not just tech, but a lot of just companies have discussed in the earnings tariffs and how tariffs have impacted this. And we want to see a positive forward guidance coming out of Apple. It's Apple and Amazon are 1A, 1B in terms of the importance to the marketplace. So obviously Apple can drive the market one way or the other. You know, a little bit of a positive mentality today coming into Apple, showing a little bit of strength like the rest of the market is today. Volume is you know, doing very good today so far, and that's a little bit of a surprise given that we're only about halfway through the trading day and we're already above average volume for Apple. So I'm looking at it. I'm looking for a breakout on Apple. Now, from a price perspective, trading it on its earnings announcement and whatnot, everybody in the market expects Apple to move 7 points, right? So whenever you're dealing with earnings, it always comes back to the assumption. Do you expect Apple to move more or less than the market does? And if you can't answer that question, then you shouldn't trade earnings. Okay. Would you agree with that, mind you?
Yeah, I would agree with that.
I mean, if you can't answer that question, whether you expect it to move more or less than the market, you should not trade an earnings position.
You have to have an opinion. And by the way, the entire discussion is how the volatility is going to play. So if you can't formulate an opinion about volatility, it doesn't mean you know. Nobody knows the future, guys. You know. That's trading, but you have to be able to formulate an opinion. Personally, I got to tell you, I'm not going to play this one bi-directionally. I can't imagine, right? Apple is a button hook, 3%, 4% type of stock every single quarter. Okay. Yeah. Revenue expectation, by the way, is 52 billion, you know, and I want you to think about the sheer size of the company. Apple is not Facebook. Mm-hmm. I will just say it like that. Facebook gapping on 20% is not like Apple gapping on 20%. If Apple gapped 20%, Matt, to me, I might go bearish on the entire market for the next 2 years.
The world would come off its axis.
it's a different kind of company because of the nature of the established foundation of the company. Facebook's a growth stock expectation. A lot of people are putting it into future earnings. All of these companies like Amazon, same thing. Apple has established revenue, Matt. $52 billion this quarter. What was Facebook's? 9, 8, something like that. You know, so we're talking about a different kind of company. Somebody flush with cash, more consumer products, more established from an actual perspective. I'm looking at it. I don't know what the gap would be, Matt, but I would probably sell volatility if it's me.
Mm-hmm. I think on Apple, it's very consistent in that gap range of 3 to 4%. You know, this 7-point price movement on Apple at 3.5%. That's very consistent, right? Mm-hmm. Tim, we didn't even have to look at the market make a move on this. It's always between typically 3 and 5%. Typically, yep. As Apple has grown to be more of a stable company than it was growth 10 years ago, for example, then, you know, 10 years ago, Apple would move 5-10% on earnings. Over the last 5 years, though, Apple is now a stable company. It's not a growth company. It's going through its Microsoft days, is basically what Apple's doing right now. And Apple, you know, to move Apple 10, 20%, Tim, overnight, you would have to have massive institutional selling. You can blow in the wind and move CMG 20%. You can't do that.
Well, or they can get somebody sick.
Well, it was probably because somebody blew in the wind.
Oh,
saying.
Yeah. Oh, yeah.
Okay, but no, I think selling volatility is the proper way to go on this. I do not expect a tremendous amount of price movement. I'm always a little hesitant though with short strangles on something that has the ability to do it. I mean, are you going to play this?
If I did, it'd be the October, 80 days out. I'd go further in time. When you're looking for cushion, it'd be really low delta. I'd probably try to get at just an extreme range, 160, 220 type range, Matt, below the 10 delta, maybe even further, and just go for like a 1 or 2% move. It's not an exciting trade. I don't know if I'm going to play it or not, but that would be how you could do it. You know, what
160, 225. Or 215. So I'm pricing a 215 by 160 strangle here, Tim.
I'd give you more upside though. 215 is 24 points, 160 is 31. So you got to, I know the deltas are the same, but the concern for me is upside gap on strangle here.
And you're going to 220 then. That's probably the most you could do here, getting 164 on the credit.
Right.
On power of, I mean, you're getting projected 8% return. Maybe you capture 1, 2, max 3% if it does nothing.
If you build the trade, you're trying to make 1% on your money.
Yeah. No, which isn't bad overnight.
In a day, you're trying to make 1% past commissions in one day, but you're probably taking the risk of, go to the analyst. Well, we can map it out. Maybe we'll do this in the coach's show, Matt. We'll do this in the coach's show, and I'll map out and I'll show people how to use it.
I do believe the short strangle and selling volatility. If you don't like the short strangle iron condor, if you believe Apple's going to move in line with the projection, short strangle iron condor is the way to go.
Yeah, I would agree.
But also by going out 86 days, Tim, you're losing the volatility crush as much as you would short term.
With a company like Apple, I'm less interested in the trading opportunity, more interested in what it's going to do to the rest of the stocks in the market.
Me too.
All the different setups and all the different things that are happening. So I'm going to be glued to this report. There's no doubt about it. And then the last one I want to look at, Matt, is Tesla. A1A, so you've got a day and a half to do a fly, Matt. I've missed trades because I wait till the last day. Do you price your inverted fly today or do you do it tomorrow?
You can do either one. I mean, I said this yesterday that without even prepping this, I'm going to do an inverted fly on it, and I am. I haven't decided if I'm going to price it today when we get done, and then I might play it today. I might play it tomorrow. But to look at this, you know, we talked about this yesterday. We talked about Tesla a lot over the last week and a half, 2 weeks in the halftime report. So I don't want to do a full-on discussion on Tesla. But if you're looking at I mean, the market is expecting something fairly significant in Tesla one way or the other. It's expecting to move between 7 and 8% over the next couple days with its earnings gap. So if you're looking at something from a short strangle perspective, I just And I'm sure there's going to be a lot of traders out there. I get it all the time when I say I'm not comfortable with the short strangle here. Somebody always lets me know that their short strangle was profitable. Okay, that's fine. I am not comfortable with the short strangle on Tesla. I want to be very clear with that because I expect a lot of price movement coming out of their earnings announcements. I expect it to move more than the 23 points. And because I expect it to move more than 23 points, that tells me immediately that the inverted butterfly is the way to go with it. We call it the inverted fly. We did the podcast yesterday on the inverted fly. So for those of you watching the halftime report today, make sure you get over there to tradingjustice.com. And you can see the last episode was on inverted butterflies. We talked about this at length. I believe we had like almost an hour-long conversation on the inverted butterfly. So you guys can go listen to that, kind of the rules and the philosophy of the inverted butterfly. And while you're over there, guys, make sure you sign up for the newsletter. It's coming out later this week, the August edition of the Trading Justice newsletter. And it is a great one. It's part 2 of system development. So make sure you check that out. But the first thing that I'm always looking at, Tim, from an inverted fly perspective is you got to look at time frame. Now, from a time frame with the inverted fly, Tim, what would you recommend to how much time to sell here? What are you thinking?
Well, you know, we talked about it at length on the podcast, but I do that 10-day option is what I do.
So you got the 10 or the 17-day option. We looked at the 10-day option here on the podcast. Now, the general makeup in the philosophy of the inverted fly is you expect price movement, right? So my standard rules are I want to do about half the market. So I'm going to buy the body. Okay, so step 1 is I'm going to buy the body. And the body is you buy an at-the-money call option or an at-the-money put option. These are going to work about the very similar here. So we're going to look at the money right here. That is the 297.5 strike price, Tim. So we're just going to go 290. Actually, it's 295. We're doing the 295 right there. So we're doing the 295 strike price. We're buying that. Now, when you're doing an inverted butterfly, you're buying 2 at the money. So you're always 2 and then you sell your wings. So you have double the contracts at the money and then you sell your wings. So again, in your standard inverted butterfly rules, you're going to buy somewhere around a 0.50 delta and you're going to sell an in the money option and a 0.75 delta and you're going to sell an out of the money option with 0.25 delta. That is standard butterfly rules. However, in an earnings position, you have to offset that rules. It's always about the market maker move. So if the market expects somewhere around 24 points, I want to sell my wings about half of that level, so either 10 or 15 points. Now, when I priced this out yesterday on the podcast, Tim, the 15-point wings were much better than the 10-point wings were, so we're just going to go to the 15-point.
Well, and here's the thing. You could even do a 12.5-point wing. Most of that really is going to come down to which strikes you pick based on liquidity, right?
Well, okay, so you know, look at this from a liquidity perspective, dropping it down to volume.
Change that gamma column to open interest. That gamma is not helping us right here. So not there. Do the actual column for gamma. Well, that works too. That works.
I can customize and take away gamma and add. Where's open interest at?
So not from that menu.
Well, it's right here.
Oh, you can do it that way too. Yeah.
Okay, so you got your open interest here. So
hold on, time out. I just learned something. I did not know you could do that.
Oh, well, you can. You've only been using TOS since 08.
Doesn't mean I can't learn something.
Hey, listen, TOS, I learn new things on Thinkorswim all the time, T. Like, it is so in depth. We've been using it for a decade now, and we still learn stuff new. So if we
I felt a little judgment there, Matt.
There's a little comment. Okay, so if this is a selling strategy, ladies and gentlemen, we're going to sell the butterfly here. Now, as you can see, I'm buying 295 call options. I'm going to sell 15-point wings outside of that. That would be the 280 by 310 contract. So as you can see, I'm selling 15-point wings. I'm getting a 251 credit, and the buying power is 1249. Tim, I don't know. I'm sure you could, but in my estimation, with what you expect Tesla to do tomorrow, that's a really good trade. You're getting a great credit for the margin requirement put up.
It's good enough. You know, I mean, I like it. I like the bidirectional play. The thing about it is and the reason I say it like,
okay, the reason good enough, which is an indication that there could be better. So help me understand how you could make this inverted butterfly better.
Listen, it goes back to the same thing I was talking about earlier. It is a good trade, but I just don't get worked up about it until, I'm reviewing it later and I see the equity curve. Inverted fly here makes so much sense to me. It's just whether you do the 10 or 15 point window. I would not do the 3-day option, by the way. And the playbook rules might say 60 days. That's not this kind of strategy. You have to know exactly how you're going to play it. My concern with Tesla really, Matt, is that I feel like I might be poking the giant here. I don't know. An inverted fly, you are playing it bidirectionally. What if the options open up? They become difficult to get a fill on. That's my concern. Little things like the management on the back end. If the trade goes crazy, I don't know. It's good enough. It's good enough. That's all you're looking for, right?
I mean, if you get a massive gap one way or the other, you might have some problems there, but that means you're profitable.
Yeah, it's true. Yeah, the worst case scenario with Tesla is a massive gap and then a big fight where it brings it back to your strike price. Obviously, that's my concern. I really believe that it's
Netflix concern.
That's right. So I am not too worried about the fact that you're going to get volatility. I would be completely shocked if you came in and saw Tesla up or down 1%. That would.
The only thing that would surprise me is that.
That's right. That would be the biggest surprise. So
which means okay, if that's the only thing that's going to surprise you, don't you have to trade the fly here?
Right. The thing I'm still debating is the 10 or 15 point window. Okay.
So in the 15 point window, you're getting 250 on 1200. Right. Okay. Right. Now you need bigger movement on that 15 point movement to be profitable. Mm-hmm. On the other one, if we do the 10 point swing, so if we sell the fly here and we do a 285 by 305, you're going to get less credit.
Half the credit.
But you need less movement. Mm-hmm. So option one, let's throw it out to the people that are listening here, Tim. Option one, you sell 15 point spread on your wings. You get 250 credit, 1,200 buying power, but you need more price movement. You need $5 more price movement for it to be more profitable. Or option two, you sell the 10 point wings, get paid 115 on 885, and you need less price movement to be profitable. Okay, so A or B. A is the 15 point spread, B is the 10 point spread. Personally, I like the 15 point spread here. And that's only though, because I expect Tesla to move more than the market does. Mm-hmm. Mm-hmm. Now, the disclaimer, if you're not around on Thursday morning to, manage this trade, i.e. Netflix, then you shouldn't make this trade. Or if you've never traded butterflies, you shouldn't make this trade. Or if you've never traded earnings, you shouldn't make this trade. You should practice it.
Yeah, that's right. Trade what you know, practice what you don't. It's a mindset that is just good for any trader out there. You should never take something you just hear and run with it because somebody tells you, including myself and Matt. Okay.
No, we do not give investment advice. It's two traders talking to each other in the open forum.
That's right. That's right.
We're not financial advisors. We're traders. There's a difference.
Well, and here's the other complexity on this one, Matt, is if you trade it now and then it moves on you tomorrow before earnings, then you've got another complexity where you got to rebalance the trade.
That's why I will typically place this trade the day of earnings.
So let's bring it back tomorrow then.
If you're looking at it coming out after the market tomorrow, you're looking at it placing it tomorrow because that is a complexity.
Beautiful. All right.
Close it out, brother.
Let's do it. All right, guys, couple of things. Number one, click the subscribe if you've not. If you've not clicked like yet, please do that for us. It helps us get this message out there and share our halftime report. We love doing this. We're coming in every day, and hopefully you guys are enjoying it. Let me know which one is your, preference, in terms of what we're doing here on Tackle Trading's halftime report. Do you love the skyline analysis? Do you love the trades? We always like feedback. That's what we're doing is we're growing this thing organically. Sign up for that newsletter, Matt. We're going to review the last final points of that today and probably release it tomorrow is my expectation, August 1st, right? Mm-hmm. And I got to tell you, Matt, it's an incredible, incredible newsletter.
It's an amazing newsletter.
Yeah, I think that it's got more value than, well, frankly, than I see ever in this industry.
I think it's the best newsletter out there right now.
Yeah, guys, go get that newsletter.
It's free.
Yep. And let us know. Make sure you read it. You're going to need some time to digest this one. This one would be one. Save it to your desktop.
It's a book.
It really is.
It's also part 2 in a 3-part series of newsletters we've done in July, August, and September on system development. One of our coaches and contributor over there at Tackle Trading, Christian Sisson, has done an amazing job in putting this newsletter this month's and last month's newsletter edition together. It's an absolutely fantastic newsletter.
Yeah, I agree with that.
And we say that with all the bias intended.
Hey, I would defend that against anybody. Yeah, for sure. I mean, it's really cool to see the kind of content that we're putting out there, Matt. And, we're going to get better at it on a daily basis. We're also going to, have fun with it as we do it.
I just wish I looked this young again. Look at that. Look at those 2 handsome young men.
Oh, Matt.
I might need to update those pictures, maybe with my handlebar.
Yeah?
It's coming.
Yeah.
It's coming.
You're looking sharp. Don't you get down on yourself. You're looking sharp. I can't wait to get that handlebar shaved out, carved out nicely,
What's happening? Listen, you have to tell me when you're going to teach the handlebar mustache trade.
All right, let me think about it. Let me think about it. No, I've already been playing them recently, so let me think about it. It's a very advanced system.
Of course it is.
Let me think about it.
We can spend 5 minutes on it the same day I do the handlebar.
Yeah. All right. Yeah, let's do it. Yeah. So I think it's going to take you about 2-3 months to grow that thing as I'm looking at it, to grow it thick.
Tim, I'm not you. There's a reason you have a goatee. It's because you can't grow the other half.
Oh, that's true. That's true. Yeah, I can acknowledge that. All right, guys, that's it for today. Thanks for being here. Thanks for being a part of Tackle Trading's halftime show.
Like and share. Thank you so much for being the best part of Tackle Trading, Trading Justice. Guys, we're out until tomorrow.